Let's just retweet and get going.
Rock and roll.
All right, well, let's retweet and get going. What do you think? Has everyone retweeted and made sure that everyone knows we're live? It's a Friday.
Amen.
I wish Bob Morris were on today because it's the first cold day in the Northeast, and we'll see if it's if the gas prices, natural gas is jumping. I follow the stocks, but not the commodities. So
EQT and EFP, he'll tell you.
This is the second show where someone's wished for another panelist versus me. I am taking it personally. I'm going to, I'm not going to kid you.
What do you mean? What do you mean? We're not saying we wish you were gone.
Looking around like, what am I, chopped liver?
Why do you take it personally? We're not saying we wish you were gone. We're just saying
one of the three. I wish one of the three of you were gone. That's what that's how I interpret it.
Well, that's a you issue, I think.
Like I said, my therapist and I are working on it. It's not going well.
That's a self-esteem issue. You really have. Let's talk about trauma in your past.
Well, no, it's trauma last night. The trauma of last night, David. The Red Sox got shut out by the Yankees.
They stunk. They need new gloves.
So I have a sibling who his entire life, older sibling, his entire life has loved two teams: the Minnesota Vikings and the Boston Red Sox.
That's asking for pain.
Yeah, I would have just given up and chosen a different team at some point, but. Well, let's get started, shall we? Shall we? We have to lower the music a little bit. Oh, that was super fast lowering the music. That's like for a Friday, that's an abrupt stop. But well, welcome to Wall Street Beats. It is October 3rd, 2025. Can't believe how fast this year has gone. And to be honest, you guys, I don't know if you realize, but you're on the show today with the #1 best-selling author in both the UK and the US. Yours truly yesterday published a book with a group of 31 other co-authors, and in our category, we're #1. Now, our category is quite
Congratulations.
Our category.
Is that a shameless plug?
It's not a shameless plug because I haven't mentioned the book yet, but if you're asking, it's called The Facts Club Experiment. The Facts Club Experiment, available only on Amazon. So if you're one of the people who does not have Amazon, well, sorry, you're not reading the book. But
all 11 of them are going to be excluded from your literary prowess. Yes.
Now, to be clear, I don't know if people understand the book business, but on a book, authors make really nothing. Now imagine you have 32 or 31 co-authors. So there's no reason to plug a book that I'm not going to make any money on, other than I do think that you'll enjoy it. And no, my co-hosts here today do not get free copies. So with that out of the way, since I know I need to make money some other way other than selling books, let's talk about stocks and investing. And I think we're going to talk about banks in a little bit, but let's talk about bakes first. And let's go through some names. I know one on your list today was Ovid, and I want to just mention, this is a stock that I mentioned as it's a penny stock. I thought it was worth taking a risk on. I forgot already where I pitched it. I want to say it was like 30 cents, but something like that. And today it's up a lot. So I don't know. Is it as it's closing in on $2? Is it time to count my winnings and get away from the table, Kevin, or do I keep going?
You guys drive me crazy. You want to snatch defeat from the jaws of victory. I don't. Snatch victory from the jaws of defeat. I don't know. This is just getting going. Look at this volume spike. And if you're telling me they raise money and they're up, then this is. And by the way, I looked at this late last night as I was going through my thousands of charts, and I didn't know David was going to bring this up here. And I said, okay, I know this is a David name, kind of a, and I like the fact that we at Wall Street Beats talk about something besides NVIDIA and AI all the time. Frankly, we talk very little about it because there's so much other stuff to do, like OVID. Look at this. This is, David in here, being Graham and Dodd, if you will. That's a little tongue in cheek because anything that says therapeutics is not. But here's the 50-day coming up through the 200. Okay. Hold. Here's the breakout above this base on big volume. And then you have this wonderful, come on, baby. And then you have this breakout into new highs here. Now, it's at the low of the day, but that's okay. I mean, if you've gone up fourfold in 2 months, 3 months, then you deserve to take a break. I think that's okay. But, this is clearly heading to the upside. And I know that you guys like to, ring the scoreboard up. In this case, I would do what we've talked about in the past. You're up 100% in a short period of time. Take half off the table. So, you say, I'm right on this and I want to stay right. And then let the house money continue to run. My eye takes me to this gap back here, which I believe is 264. Okay. And I think you go to that without too much trouble. And then you have to eat through this level here. But that's up another 50% or so. And this is taking out escape velocity. This is working, and I don't know the fundamentals from anything, and you can enlighten us. But I think from here to 264 is reasonable, and that doesn't sound like much. It sounds like less 70 cents, 80 cents, because we're moving around here. But I think that if you're right, stay right with the remaining profits that you have. Maybe you wanted to keep an eye on the 1 year mark, and then you say, okay, I want to take the long-term capital gain, down the road. But this stock has clearly been higher. Something clearly has changed, and it's a launch pad that's just taken off. So I would sell half, but I would let the rest run because this looks fantastic to me.
Yeah, so I'll tell you what I'm doing. I'm not selling any. I might even buy some more here. What's going on? It's still super risky, but let's go back 6 months or a year and we say, well, I don't know if anyone, I'm sure some people watching right now have done this, but you watch the live poker on, I forgot what TV station has it, but they do high stakes poker on TV. Poker is a game I don't really understand, and I would never. I'm not. I don't need to gamble. But what they'll do is they'll do live odds on who's going to win the hand, based because they can see the cards that each person has, and that changes during the card game. Well, a year ago, Ovid looked like 100% that it was going to go out of business. Maybe I should say 90%. They didn't have enough money and to to finish out the trials that they were doing, and no one wanted biotech. Now, all of a sudden, the odds have changed dramatically. Biotech's had a great run. It's almost caught up to the S&P year to date, which is like a historic run for them because it had underperformed for 5 years, not caught up for a 5-year return, caught up for a year to date return. And biotech, more speculative things are in favor. In addition, this raise that they did today helps them. They don't need to raise money now until they get the readout of the trials. Now, the bigger risk is these trials don't work, and these are early phase things. And given their history, there's a good chance that they don't. Now they would argue that that's not true, and that's fine. I will tell you what I emailed the CEO today. I said, look, I don't know if it's because I discussed it on Wall Street Beats or I'm really good at timing, but I'll take either one as a compliment. Give me a call later today. But that's Ovid. It's a small cap stock. What else do you have, Kevin, for us today?
Just before we get off of Ovid, what's the next catalyst in your mind?
In my mind, spending the rest of the day outside. Oh, you mean for Ovid?
Is there a phase 2 trial data readout or?
Yeah, late this year they're going to have readouts on 2 studies. So you're gonna find out late this year, early next year, whether or not that raise was great or horrible. But $175 million, I'm going to be interested in seeing the holders list after this. But that's not a small amount of money for this kind of name. So someone has confidence that these studies are going to work.
Yeah, and I don't want to do it here, but my suspicion is the short interest is pretty high and coming down. So you have a winner, and I would let it ride, and maybe keep an eye towards those data points coming up at the end of the year.
Yeah.
All right.
But let's go to something bigger and more beautiful. What else do you have?
Well, no. This is not more beautiful, and this is a little bit controversial. Bernard Brachet, our colleague here at Wall Street Beats, has forgotten more about these companies than I know. She knows the fundamentals inside and out, and I just come in and go through all my charts and say, this is taking on some serious technical damage. These are the 2 betting companies, DraftKings and Flutter, which owns FanDuel, which, by the way, has a new partnership with CME Group, which is on a great podcast with Odd Lots. So the expansion of gambling, events, contracts, if you will, prediction markets for elections and what have you, is really starting to expand, and is attracting competition. I think Berner would say that this is the fillet, and we don't have and everybody else that's doing this is hamburger. But what strikes me is that on my phone, I got a horrible echo. Hey, whatever. I think the new competition can be said to be not that big of a negative, but I can't make it a positive, and the chart can't make it a positive. You have the 200-day going down here. You have the 200-day breaking. This is Flutter, which is FanDuel. The DraftKings is going in lockstep. And there's some serious technical damage getting done. And I just caution people that, if you know the fundamentals inside and out and you believe in it, then this 250 support of FanDuel looks pretty good. But the fact that there's this down volume for 4 straight days, can't catch a bid, and just some other little things. I follow our competitors and anything to do with, frankly, investing, especially for young people, I follow. And Robinhood shows up in my feed about every 5 minutes with a new gambling application for football. And it's just the number of people that are getting into this space seems like it's increasing. It's not a death knell, but there's clearly damage being done to Flutter and DraftKings. And I think you can rally here. I'm going to watch the rally. My guess is that it's more than a guess. I think I've seen this movie. I think we're going to rally on low volume up to this descending 200 day. Nothing good happens below the 200 day. So with the DraftKings, maybe you rally to 40 or so. And but there's some clearly damage getting done. The market at least thinks that this new competition is going to impact their earnings down the road. I could be wrong. Berna could be right, but I would, reaccelerate my fundamental work if I was doing some. But the technicals to me, I wouldn't. I think, frankly, if what I see happens and you have a low volume rally into 40 that dies, then you start looking on the short side. So I don't like DraftKings. I don't like Flutter. Happy to discuss with anybody, but I got to put it out there. Crickets. Okay. You there, gang?
David, you're on mute.
I said,
David,
sorry. Yeah, no, I had a hilarious joke. I mean, as a best-selling author, sometimes I mute myself. No, I said, so you're betting against DraftKings, but I guess my better
That's
sense
a dad joke at best.
My dad joke censored myself.
Now,
So all right, what else do we have?
Full disclosure, I'm not involved. I can't own individual stocks. I don't really see a great ETF that owns these. Certainly none that short these. But I have to call balls and strikes as I see them. And I think you've got low volume rallies coming. And if it's a V and you rip back through 40 on the case of DraftKings on big volume, then it's a different topic entirely. So that's what I have there. Lastly, I know I'm talking about, I'm a broken record here, but I bought silver, SLVR, which means I bought more silver related ETFs. I already own SIL. It's up 53% since June when we bought it. This is the buy of Sprott Silver Miners, SLVR. Owns some physical silver, about 16% of the portfolio is physical silver. And I said, I say I go through 5,000 charts. I find the best 10 ETFs to invest in, and now 2 of them are silver. So I'm basically 22% in silver. I'm roughly half the S&P 500 and half bakes, and so I'm 11% in silver. And I looked today, and spot was 47.77 when I came on the show. Spot, the silver price, the metal itself, and it's right below that 50 level. That to me is a significant, and I mean 45-year breakout. It has not done that yet, but the miners are telling me it's coming. And when it does, I just want everybody to hear from me. I don't know, this is the 3rd or 4th time I brought it up on the show. When it's 50 plus, then we're really going to get going. And it's Hunt Brothers 2, the sequel. So I think it's going to happen. These are extended. I'm not going to kid anybody, especially myself. A lot of stocks are extended way above the 200-day moving average. It's a bull market, and that's what happens. So the pullbacks can be pretty severe. I will keep my sell discipline in place, but come back to this space. Silver, I think, is going much further north, and I'm looking for, when I see a $50 close on spot silver, I'll tell you about it.
But if you didn't own it today, would you be buying it today?
I wouldn't, because it's extended from my buy point. Anything that's 5% over my buy point, I just say, okay. And this is happened. This is indicative of the market we're in. It's happened a bunch. I bought LIT. I own a tiny amount. It's lithium batteries, Tesla, etc. And I can't own more of it because it's up 13% in less than a month, and it's just run. So no. I think what's going to happen is spot hits 50-ish, consolidates below, the 49, 45, 1980 high. And I keep bringing that up because the longer term double top of 80 and 07 is really meaningful. Now, if we close above 50, then you can buy with both hands, in my opinion. I'm already here. So I own 22%.
Got
I
it.
own two. So that's what I got.
All right. So
Big,
we're
big,
gonna make
big.
all this money. Let's just move on to the banks, Charlie. So you're gonna make all this money. You're gonna need to put it somewhere. Charlie, am I putting it in a bank? Am I putting it in bank stocks?
I like
What am
what you
I
did
what am
there.
I what am I doing
Well,
with all this?
I say I'm with one of my top three positions is SLV, so I own physical silver. But I would say if you're going to commit new money in this area of metals, copper and palladium are the incremental buys for me. So PALL is palladium, and copper. I'm in Ivanhoe Electric on the theory that that's one that will benefit from the copper boom for data centers and other construction, but also the fact that the government is taking stakes in some of these companies that are deemed strategic metals, and I think Ivanhoe Electric is one that they could look at. So anyway, let's move on to the banks. Let The banks are the first to report third quarter earnings starting October 14th. The bottom line is the news is going to be very, very constructive. Now, obviously, you shouldn't be buying bank stocks on third quarter earnings. You should be looking at it 26, 27 earnings. But they give you sort of the base from which people are going to extrapolate, 26 earnings. Let me, Jen, if we can put up the first slide, I would just want to take a broader look. So these are the 11 sectors in the S&P 500. The top is the earnings growth, and the bottom is the revenue growth. I know it's hard to read, so let me just go to the observations page. That might be easier to read. The S&P 500 for the third quarter is projected to grow earnings at 7.9% year over year, and that's on revenue growth of 6.3%. The financial sector is expected to grow earnings 11% year over year on revenue growth of 6.7%. So the bottom line there is that the financials are going to show better earnings and revenue metrics than the S&P 500, implying that they should the stock should do well going into earnings. Of the 11 S&P sectors, financials should generate the fourth highest year-over-year growth rates in earnings and revenue. So a very constructive picture. Within the financial sector, there are 5 subgroups, all of which are going to grow earnings and revenues on a year-over-year basis. The fastest growth is the consumer finance, up 26% year over year, which is interesting because coming into this period, we've seen a sell-off in a lot of these consumer finance companies on the fear of credit risk. And I'll come back to that because that's the one thing that could halt this rally. Capital markets, the Goldman Sachs, the Morgan Stanleys of the world are going to be the next strongest growers because we've had a huge revival in M&A and equity. Financial services, which I guess is things like Visa, MasterCard, is going to be up 10%. Insurance up 9%. And by the way, I think insurance is starting to roll over, and that sort of tends to lead sometimes the market. And then banks are bringing up the end. And that's what I cover are the commercial banks, although I have my fingers in a lot of these other sectors as well. So we can go to the next. Next slide. This is the revenue outlook for the banking sector. If you go to the far right-hand column, that's the year-over-year growth rate in revenues. The salmon colored, I put that up because I know Bakes like that.
I love when you talk about salmon. You feng shui artist, you.
But the banks are going to grow revenues on average at a 4% rate. The capital markets, which are the bottom two, Goldman Sachs, a little stronger at 7.8%. So you can see the difference between the banks that are driven by NII versus capital markets. And revenues are going to be the deciding factor in this earnings season as to which banks trade higher and which banks lag. And my thesis is that NII, net interest income or spread income, is going to be the better differentiator as to how stocks trade versus capital markets. And I say that because I think NII is going to accelerate into 26 whereas capital markets are probably going to be peaking sometime in the first quarter of 26 in terms of momentum. So let's go to the next. So I don't know if you can read this, but this is the net interest income, and I would just say if you look at the third quarter numbers, the revenue growth is going to be strongest at these three banks: Citizens Financial (CFG), which I have buy rated, and it's my play on a hot economy; Bank America, which is going to have very strong NII; and JP Morgan, which is hitting the ball out of the park on capital markets. Those three are the fastest growing revenues. But net interest income, and for all three for different reasons, but net interest income is going to be, I think, the deciding factor on the revenue side. And there, the three fastest are Citigroup, which has been my number one pick, also happens to be the best performing bank stock year to date.
Congrats. That's a good, that was a
phenomenal.
great call. Great call.
It's up
Fabulous.
41% year to date. And then Citizens Financial, CFG, has also been on our buy list. It's going to have strong NII, PNC, and Bank America. Those four are going to show the strongest NII, and I think that's going to be the driver going forward. So we can skip to the next slide, Jen. All right.
No salmon. You call this a slide? There's no salmon.
Yeah, I don't know if you can read this, but the bottom line, this is Jefferies that just reported results this past week. And I want to make observation about two stocks. So Jefferies reported phenomenal earnings, really good earnings, and the stock sold off hard. And then Jefferies, by the way, is a capital markets play. The other name that got good news this week was Morgan Stanley, MS, and they got capital relief from the regulators as they recalculated their capital requirements, and the stock sold off on that news. So here are two capital markets oriented names that had good news and sold off. And that gets back to my belief that capital markets is peaking. So if we can go to the next slide, Jen. Keep going, one more. To the capital markets slide. Go one more, Jen. Yeah, this one. This is the third quarter expectations for capital markets. And what you're going to see in the capital markets reports is that equity and M&A is taking over as the driver of capital markets revenues. And it's surpassing fixed income trading. And typically when fixed income trading, which leads the cycle, starts to give way to equity and M&A as the driver of revenues, that's the mature phase of capital markets. Now that mature phase can last for a number of quarters or a year or so, but it's my expectation that this M&A equity cycle is probably going to peak in the first half of 26. And so the question becomes, what do you want to pay for peak revenues in this capital market cycle? And I think that's what Morgan Stanley and Jefferies were telling us on the sell-off on good news, is that we're getting close to the point where people are going to start to peel off some of their profits in this sector. It does not mean that the reported fundamentals are going to get worse. They're going to be very positive going into the first half of next year, but it's also the mature phase. So it's a question of what do you want to pay for that.
For companies that are capital market plays, do lower interest rates affect like M&A levels or offering numbers of offerings or anything like that, or is it kind of irrelevant for those that aren't like loaning out money?
No, I mean, obviously, lower interest rates improve your multiple. So for IPOs, that's very positive. For leverage buyouts, lower borrowing costs, improve the prospects of leverage buyouts. I will mention one, Electronic Arts, that is the largest. It's a $55 billion buyout that's been announced. It's being funded by a commitment from JP Morgan of $20 billion, which is the largest commitment in history. And it reminds me, for those of you that have gray hair, and I know neither of you guys have gray hair because you have no hair at all, it reminds me of RJR Nabisco, which KKR took out in 1989. And that marked the top of the capital market cycle, if you remember correctly.
It's funny you mentioned that because remember, Electronic Arts sells games.
Yeah.
Unlike RJR, where you could say, well, look, there's a long history, a very, very long history, and an annuity factor. I'm not so sure that you have the same risk profile for a games maker. But I mean, I know JP Morgan doesn't do things, half cocked. So I'm sure that they thought this through, and I'm sure it goes out to 500 other banks as well. But it just seems like a something on the risk curve that's a little bit more aggressive than usual.
I think
This
it
is
is.
this is apparently the Saudi prince is a gamer, and so the Saudi wealth fund, I believe, spearheaded this deal, and so it doesn't have the same sort of financial metrics that are normally associated. The Saudis think they can turn this more into a free game and a mobile play than it has been, but it's an oddball
It's
to be
actually really
sure.
it's interesting you say that, because they were rumored to take giant stakes in Nintendo and Capcom
Yep. Yep.
about a year ago. So yeah, that's fascinating. But
Yeah.
Charlie, you
Yeah.
were about to say something.
No, just that it is a very competitive environment right now between the banks and the private credit industry. And so I think, JP Morgan, in order to get this deal, had to be fairly aggressive either in their underwriting or their commitments. And they've committed to taking down $20 billion. And this thing does not close until the middle of next year. So you've got a 9-month period here where the capital markets can change on you, and yet you have to fund this thing. So I think it's a huge risk. Um, and so, this could be, JP Morgan's next London whale. For any of you remember the London whale trail that got in trade that got JP Morgan into trouble. I don't, JP Morgan's a great franchise, but it's selling it literally over 3 times tangible book value. So, given the pricing and some of the risks that they're being forced to take in order to, feed their franchise, not a stock I want to be long right now. And yet it is the darling. Everybody owns it. It's
So
over owned.
maybe Jamie Dimon's trying to get on the Madden football cover. You never know.
Well, he's certainly on the cover of the Madden Bank, history roll, I guess.
Yeah.
But
Hey Charlie, let me run this by you.
yeah,
It's kind of like with I think they financed Elon's buy of Twitter, so they get in the good graces with Elon, so they can do SpaceX deals down the road. And now they say, okay, and maybe they've got a great relationship with the Saudis already, but now they make it even better, and they just make a business decision. We'll take this risk because we'll make more money off the Saudi wealth fund down the road.
yeah. I think it was Morgan Stanley. If you're talking about the X, the buyout of X, that was Morgan Stanley, not J.P. Morgan. I wasn't
Oh, all
talking
right,
about.
my bad.
Yeah, but yeah, no, I mean, listen, these guys are all trying to gain favor with the big boys that have deep pockets, and J.P. Morgan is better at it than most. I mean, I have tremendous respect for Jamie Dimon and the franchise he's built. It's the best in the industry, best balance sheet, best franchise, best management. But it's just not a stock that I want to own here. It's overowned. Everybody has indexed their portfolio to JP Morgan as a financial play. So I think it has more risk than others. Let me just, I know we're running long, so let me just conclude here in terms of what to expect. Jen, if we can go to the slide on earnings estimates. So these are the earnings estimates that the left-hand white column are my estimates. The salmon column next to it is the street estimates. And where you
Thank
see
you.
me above the street is, significantly above the street is Citigroup, my number one pick. JP Morgan, as I said, I think they're going to have gangbuster capital market. Anybody that has capital markets in their play, like JP Morgan or Citizens Financial, are probably going to beat street estimates because it's just been a phenomenal quarter for M&A and equity. But yeah, I mean, the bottom line is this group is going to show 13% growth year over year, whereas financials in general are going to show 11% growth over year. So the banks there's no reason in terms of the third quarter earnings reports for banks to sell off. But let's go to the last slide, and I'll tell you where the risk is. All right, so these are the fundamental trends that I think are going to be reported in the third quarter. The far right-hand column gives you the year-over-year change in third quarter fundamentals. top line is revenues are going to grow 4.8% year over year. And that's going to be a mix between 5.1% net interest income and 4.4 of fee income. Fee income is where the capital markets are reported. So it's a pretty balanced mix of revenues between spread income and fee income. Provisions, loan loss provisions, which is the credit quality indicator, are going to be flat. So there's no concern coming into the quarter about credit quality. Expenses are going to grow in line with inflation, but grow slower than revenues. So you're going to have positive operating leverage. And so you're going to be looking at, high single digit, low double digit earnings per share growth. And that's, so that's a pretty constructive quarter. The question is what I talked about on Wednesday with Dave, and that is if you look at the tertiary names, things like Sally Mae, Ally Financial, Bread Financial, Synchrony Financial, Capital One, Credit Acceptance, CarMax, you're starting to see credit deterioration in these tertiary names. And right now, the belief is it's relegated to the subprime sector or maybe even just to the auto sector. And so the question is that going to bleed through to the primary names like JP Morgan over the next 3 quarters? I think it is, but that's a supposition. On the third quarter earnings conference calls, as I said, the earnings reports are going to be phenomenal. So it's going to come down to what do the management say about the environment. And I think managements are going to continue to be fairly constructive. So I see no reason for the primary names to sell off, going into earnings. But I probably would take profits in these things coming out of earnings if they rally one more time. So let me stop it there because I know we're out of time. But
Yeah, we're running a little long, but that's really interesting because I own a bunch of bank stocks from former employers, and none of the ones that you like. So that's a problem. But that's all right. That's all right.
Yeah. They've all done well. I mean, Citizens Financial and Citi have been the 2 best performers year to date. The one that I'm incrementally recommending is US Bancorp, USB. It's been a laggard, but I think they're finally starting to show some improvement. So that's the one I would incrementally buy here.
Yeah, and then just lastly, was it Mitsubishi that bought a piece of Jeffco this last week or 2 weeks?
You mean Jeffries bought a?
Yeah, Jeffries. Yeah.
Is it? But it may have been, or Mizuho. I'm not sure which one it was, but
Okay.
yes, it was a.
I was just wondering if that's like consolidation, if they're, because they're, as you said, they're a capital markets play. If this is like long-term thinking that, okay, this is the way a Japanese bank gets bigger in the US, but also that Jeffries becomes bigger in lending. So, but just a thought.
As you know from history, Japanese banks tend to buy at the peak of the U.S. market.
Yeah. I've been employed by a lot of banks, but I was never employed in one that got taken out. But I do have a colleague who left our team. He was an analyst, left, and he was bought out 2 weeks later. His contract, he was bought out by the bank our bank that he left. And so his contract was bought out. His 2-year contract had to be bought out, and then we hired him back. So he, he never sent me like a box of wine or anything like that. So
I think he's buying books right now as we speak. Buying your book right now.
Buying books. Well, on that note,
if you buy me out, I'll send you a case of wine.
Exactly. Thank you. Well, it is October 3rd. It is a Friday. We're going to ease into the weekend. The market's up. The weather's great. Hope you have a great weekend, everybody. And thanks. If you're interested in Wall Street Beats and seeing our behind the scenes, getting our notes and the rest and the details, such as Charlie's deep research and charts, just go to wallstreetbeats.com or passes.com/wallstreetbeats. Have a great weekend.
Thanks, David. Thanks, Bates.
Thank you very much.
Thanks, Jen.
Jen, thank you.